I think also there's a premium that comes to leasing space to marijuana growers. Obviously, there's a lot more risk involved. It still is illegal federally. So don't want to be involved. So I think if you are an owner and you would be interested in having one of those tenants, you could probably double or triple the asking rent of what you would get from a more traditional user.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, and they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hello, and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and with me today, I've got Mike Roessle. Mike, how are you doing today?
Doing very well. How are you?
I am fantastic. So Mike, a little bit about him. He's with CoStar and brings nearly 20 years of industry experience and expertise. He joined CoStar Group in 2017 from Colliers International, where he was the director of national office research. Throughout his career, he's focused on analyzing commercial property trends and economic drivers to deliver timely market projections to brokers and clients with the dedication to excellence in analytics, data management, and quality assurance. So a lot of data. It looks like you're digesting data every single day, which is fantastic. And I want to spend some of today's episode on that. And with CoStar, you guys, for the listeners who don't know what CoStar is, I guess I'll let you just kind of give a little like snapshot. What is CoStar? What do you guys do? Why are you important?
Sure. Well, CoStar is the leading provider of commercial real estate information and analytics. So broadly, we cover all four major asset types: multifamily, office, industrial, retail. We have subsidiary companies as well. We own apartments.com. Which enables us to have a really extensive amount of information, particularly on the multifamily sector, which I know we're going to be discussing today. So in the Twin Cities alone, we get about 40,000 rent observations per day based on our agreements through CoStar.com. So we really have a wealth of information there. The brokerage community can use it to put up any space listings they may have. Brokers, analysts, lenders, developers will use our product for the analytics, for our market reports, to look at historical trends, our forecasts, to get a picture of where the market is, where the market was, where the market is going, as well as our economic information. So of course, economics informs pretty much everything in commercial real estate. Job creation leads to new household formation, which leads to an apartment unit rented, which leads to a vacation and a hotel room occupied, which leads to also some more expendable dollars, so retail and industrial throughput. So all of that really ties in to what we can provide to our clients.
Awesome. And obviously we can never predict the future, but what is CoStar trying to do today to try to help predict that future and to give clients the opportunity to be able to maybe make the best informed decisions on not only what's happening today, but what might be happening in the future?
Sure. On the economics side, we partner with Oxford Economics for their data. We rely on their base case forecast to look at future projections, including job growth, employment, median income, all of those different economic variables. We do offer our clients alternate scenarios. So if you feel that the base case is not the most likely scenario, We do give multiple options for a trend case scenario, which basically takes the trend over the last three years and carries it forward. We also offer upside and downside scenarios as well. So you can customize it to what you feel, or just go ahead with the base case. And then in terms of fundamentals, real estate fundamentals, we use our data, we use the history, and we have a team of quantitative analysts who then uses models to predict what's going to happen in terms of vacancy rates, in terms of asking rents. We use the same store rent series to do that. So it's not a space occupied rental scenario. It's actual rents in the same properties quarter after quarter, year after year, which gives you a truer picture of what the market's doing and where it may go.
Awesome. A lot of good information. I know I've definitely relied on a lot of CoStar reports and the information the brokers definitely provide, which is typically CoStar every time it is. So let's talk a little bit about what's going on in today's real estate market. We can let's maybe cover the gamut of the four main areas. And if you want to, I don't know, obviously we're Twin Cities based, you're Twin Cities based. We can cover nationwide, or you can just hone it down to the Twin Cities, whatever you feel more comfortable with. But let's talk about the four a little bit, maybe some of the trends, some of the positive trends, and maybe even some of the negative trends on the four categories.
Sure. Maybe we'll start with retail, since that seems to be getting a lot of press recently.
Yeah.
In terms of e-commerce. We've heard a lot about the death of the brick and mortar retail sector. I think stories of that demise may be overstated a bit. E-commerce is certainly a threat, and it's certainly had a tremendous impact, not only in the Twin Cities, but nationwide. That's undeniable. But I think there's real opportunities, and I think what it's forced to do, what it's forced brick and mortar retailers to do, was really refresh their brands, refresh their inventory, and take a fresh look at what today's consumers actually want. And I think it's made brick and mortar retailers better. And those who have adapted, refresh their brand, refresh their inventories, offer what today's consumer wants, have been succeeding. And those who haven't, well, I think we've seen the stories. I think, quite frankly, I'm surprised Sears has lasted this long. They've offered the same array of merchandise essentially for the last 20 to 30 years, and
maybe longer.
Maybe longer. And nobody was interested in that anymore. They wanted a different way to shop. They wanted different goods. They wanted different experiences. So, I think you've seen that story. I think retailers have also been forced to maybe right size, not necessarily downsize, but right size, and focus really more on their better performing, located stores and allocating more resources to those, and closing some of the less well-located, poor performing stores. So, I think ultimately it's been better for the retailers' bottom lines. Certainly experiential retail is all the rage. It offers things that the internet still can't provide. And I think, you're seeing that even with our homegrown company, Best Buy. I think a lot of people may have written Best Buy off a few years ago and thought, well, Amazon's going to dominate in terms of selling TV and electronics. But they've really refreshed what they do. I think it was smart of them, to partner with Amazon in selling TVs. And also their whole Geek Squad concept, where they offer a bundle of services now. So you can go to a Best Buy, you can get your new big screen TV, have the Geek Squad come out, they'll mount it on the wall for you, connect your surround sound system for you. And they recently launched a around-the-clock 24/7 tech support program as well. So if you're having problems with your laptop or any of the tech you've purchased, that's available. So I think they've really turned around what they were doing and focused more on offering those services to the consumer rather than just the goods. And again, that's something that the internet can't offer. So I think there are opportunities. Different niche experiences. In St. Paul, there's the Can in Wonderland. So I think some bars that offer axe throwing now. So those kind of experiences that again can't be replicated online seem to be doing well, as discount retailers. So your Saks Off Fifth, your Nordstrom Rack. those are seeing great success as well. I think the market's a little bit bifurcated in that your ultra luxury centers and stores and malls around the country are doing really well, and your sort of discounters are doing really well. And those commodity malls, those Class B type assets, aren't performing as well.
Interesting. So it's more of the, yeah. So either by A or by C. Don't buy in the middle. Yeah. What are we seeing as far as occupancy trends, as far as rent trends? Are we increasing on rents? Are we increasing on occupancy, or are we decreasing? What are we seeing there?
Yeah, rents here in the Twin Cities have been virtually flat over the past few years. So we haven't really seen strong rent gains in terms of asking rent. Occupancy, however, remains remarkably strong. We're not seeing widespread market-wide double-digit vacancies. And I think despite the lack of rent growth, investment activity has been fairly strong in the retail sector here. I think investors are still attracted to retail centers. We've seen strong investment volume over the past few years. So I think maybe what you may sacrifice in rent growth, you're recapturing and going in yields. So I think that's attractive to some investors.
Yeah, definitely. What kind of, maybe you don't have this up the top of your head, but what kind of cap rates are you seeing on just a typical, let's call it B class building?
They vary widely, but you could see cap rates probably in the 8% range.
Okay. All right. Well, let's go on to maybe industrial.
Sure. Industrial, another red hot sector here, in addition to multifamily, but obviously e-commerce is driving a lot of that growth as the worlds of retail and e-commerce continue to converge. And while the Twin Cities isn't really a regional or national logistics hub, it is very important for those last mile distribution centers to deliver the goods, as we've all become used to ordering something online, and it went from expecting it to 2 days to the next day to now within 2 hours. So as consumer expectations have shortened in terms of delivery time, you certainly need to build out a better logistics hub to enable that to happen. So I think certainly we're seeing a lot of growth in the logistics sector. What's interesting is the specialized sector, which includes things like cold storage facilities. I think that's something to keep an eye on looking ahead as the worlds of e-commerce and groceries converge. It's really still in its infancy. I think only around 2% of groceries or grocery shopping is done online now. Despite all the hype it's been getting, it's still a very minimal portion. But I think we're going to continue to see that grow. And in order for that to grow, you're going to need cold storage facilities, obviously, to keep the goods fresh while they're being transported. And really, not only here, but around the country, not a lot of those facilities exist, and not a lot have been built over the last few years. So I think as demand continues to increase, there could be some real opportunities there in terms of building or investing in cold storage facilities. Despite the winters we have here in Minnesota, it is still necessary to keep those goods fresh. But I think that's an opportunity in industrial. I think another interesting potential opportunity could be if somewhere along the line the state legalizes recreational marijuana use. I think we've seen in other markets that have gone that route. There's a lot of initial demand, increased demand for industrial space, warehouse space. I was just in Denver and speaking with some folks there about it. I think also there's a premium that comes to leasing space to marijuana growers. Obviously, there's a lot more risk involved. It still is illegal federally. You don't want to be involved. So I think if you are an owner and you would be interested in having one of those tenants, you could probably double or triple the asking rent of what you would get from a more traditional user.
Wow. Yeah, so something to keep an eye on, definitely. How about their rents? What's happening with the rents? What's happening with occupancy? And where are we looking at cap rates approximately for like a B class?
Yeah, I think we're seeing solid rent growth. We're seeing some of the strongest rent growth in the last decade over the past couple of years. So, we're looking at, 3-4% range for annual rent growth in the industrial sector, which may not sound like much, but for this market, that's particularly strong. The long-term average growth rate in the industrial sector has probably been 2% or below. So those 3 to 4% numbers we've been seeing recently are pretty strong for this market. We're not a coastal port city, so we're never going to see those 12, 13, 14% gains that we're seeing in some of the markets in California. But this market's never performed in that way, so we should
in any sector, quite frankly.
Right.
Yeah.
Exactly. So I think 3 to 4%. It's strong and it's manageable going forward long term, rather than a boom and bust sort of example.
Yeah.
In terms of cap rates, I would characterize this as probably a get what you pay for market. Again, long-term rent growth has been a little slower, so you're looking at, higher yields to make up for that fact. So, again, I would say probably in the 7% range would be a fair number.
What kind of is occupancy strong? Is it we looking at 80s, 90s? Where are we at?
Yeah, absolutely. Occupancy is very strong. I'd say above 90%. Tenants certainly have had trouble expanding within their current facilities. So I think that's what spurred a lot of the build-to-suit construction we've seen over the past few years, and we've even seen a fair amount of spec construction.
Yeah.
And that's done very well. It's leased up pretty quickly. So I think the demand is out there for bigger, larger sheds with ever higher ceiling heights. So I think as big as you can build it, you'll find demand for it.
Cool. Let's move on to office. What are we seeing there? What's going on with the office space?
Yeah, office is it's steady. I wouldn't characterize it as a hot market here, but I'd say it's steady. I think there's a lot of tenant churn. I think those landlords that have newer Class A 4 and 5-star assets or have newly renovated product are at a competitive advantage. I think tenants are looking for the latest and greatest in terms of amenities. With an unemployment rate in the metro, at or below 3%, the talent war is very real here. So having office space that will enable a corporation to retain and recruit their employees, I think is paramount. It's very difficult for employers to expand and hire people. We're just literally running out of people here in the metro to hire. So it's become paramount to have the latest in office space and office space design. I think some of those deep suburban office parks in the 1980s vintage that haven't been updated, you wonder really what do they have left to offer and what are they going to turn into, because I don't know that they're really that competitive going ahead. So maybe a repurposement might be the highest and best of those.
Is there a lot of you just mentioned the 1980s or 70s even office building, but at the same breath you mentioned that people want these newly renovated ones. Is there a lot of opportunity to take in one of those tired old buildings that hasn't been touched since 1974 and renovating the thing and putting in new baths and lighting and all that kind of stuff? Or is that really not that lucrative?
I think there is value add opportunity there. It depends on the asset. It depends on its location. I think you need to be well located near one of the major highways. So, if you're in the 394, 494 corridor or in one of the CBDs, I think that's attractive. But if you're an isolated office campus that doesn't offer good proximity to the major corridors or have public transportation options, it might be hard to attract tenants there.
Yeah.
And I think really for all the talk that everybody wants to work in the Minneapolis CBD and is moving to Minneapolis CBD, I think to some degree there is some truth to that. But I think that parking is a real issue. I think it's not just a casual throwaway line, but it's become a real problem. And I think well located modern suburban assets can have a leg up, and a lot of times when they could offer ample free parking. In the CBD, I work in the CBD every day. and more and more surface lots are becoming multifamily buildings. They're tearing down decks. So, until we either get a fully robust public transportation system where people, in all the inner ring suburbs can take advantage of it, or something shifts, I don't think this is going to be a metro that ever gives up cars. And I think particularly, I'm a proponent of public transportation, but I understand it's not for everybody. If you drop your kids off at school and they have soccer practice and you have to pick them up, your only option is to drive a car to do that. So I think for as much as larger locations want to have a CBD presence, I think there's also a good argument to be made that, again, the death of the suburban office campus is greatly overstated as well.
What are we seeing for occupancy and rent growth there?
Occupancy, vacancy rate is a little bit higher. We're probably pushing in the double-digit range. And that depends on what you account for. If you subtract all the single tenant buildings, all the owner-occupied buildings, all the government-owned buildings, we're probably in the teens in terms of vacancy rate. If you include all stock, it's a little bit lower. So it depends on how you want to slice the data.
Yep.
Rent growth has been surprisingly good over the past few years. And I think, that leads to a couple of questions. On the face of it, is the market really that strong with such a high vacancy rate that landlords can push rents? Or are those asking rent increases masking very generous concession packages to fill the building? So are we seeing, a year, 18 months of free rent, $60, $70, $80 a square foot in TIs that's covering up those asking rent increases? On the other hand, or are those asking rent increases just being driven by a handful of new or newly renovated buildings that is kind of lifting the tide for all boats there? So, it's definitely worthy of a discussion on what's really driving those rent gains. Is it, a really tight market that's very healthy, or are there a lot of giveaways on the back end?
What are we seeing cap rate on a B class office?
I'd say probably mid 7% range for B class.
Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments, hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com.
Let's dive into my favorite, multifamily. Let's do this. I got a lot of questions here.
Great. Yeah, multifamily continues to be incredibly strong here in the Twin Cities. I think the fundamentals have been performing terrifically through mid-year. They remain very strong. The vacancy rate, is in the 4% range, one of the lowest in the entire country. Mid-year, we had rent growth numbers at 3.6%, very strong again. We've seen growth in the mid 3% range for the past several years.
And again, that's for people that are listening from outside of our state. That's really strong for Minnesota because we're typically seeing inflationary rates, and that's it. We're seeing that 1 to 2% typically.
Right. Yeah. Historically, the trend growth has been much lower. So this has been an exceptional run of rent growth here over the past 7-8 years.
Yep.
In terms of supply, despite all the cranes we continue to see in the sky and the deliveries every year, I would argue that we remain undersupplied as a metro. I think, construction really didn't ramp up in the metro until around 2013, 2014. So we kind of got a late start heading into this recovery. Not a lot was built prior to that. So we're making up for lost time as best we can. And in terms of total percent of inventory under construction, which is an interesting metric, the Minneapolis metro has about 5% of the total inventory here that's currently under construction. So it's a very manageable amount when you put that in perspective to some other metros around the country. I know Denver, for one, Stamford, Connecticut, a few others around the country were pushing double digits, so 10, 11, 12% of total inventory under construction. And that's a lot of supply. So I'd be much more concerned about some of those other areas than the amount of supply we have here.
Are we seeing, when we talk about supply, do you have the numbers, what we're seeing as far as supply coming in this year?
Yeah, I think we should be in the 5,000 unit range, pretty close to where we were in 2018. There's a strong pipeline ahead for 2020 as well. So, I think developers, certainly are active. They don't see a major slowdown coming in terms of demand. I would say that if we do run into economic headwinds in the next 12 to 24 months, we're still pretty well positioned. Our forecasts don't call for dramatic reversals. So even if we buy into the base case scenario of slowing job growth, we see the vacancy rate just going back up to the historical average of the mid 5 to 6% range. So it's not going to spiral out of control here in our estimation. And rent growth certainly is anticipated to slow should job growth slow. But again, we don't see market-wide negative rent growth on the horizon, even in that scenario. So I think we're in a good place.
So we got 5,000 new units. Do you know how much growth we're having as far as household growth?
Off the top of my head, I don't have the exact growth number there. I do know that particularly in the CBD, the Minneapolis CBD, I think between 2010 and 2018, I was looking at the Met Council numbers, Minneapolis grew by about 12%. So there's about 430,000 residents there in the Minneapolis core. St. Paul grew by about 10%. And this isn't limited just to the core areas. Areas like Lakeville have seen double-digit percents in population growth. So I think we are seeing strong household growth, and I think that's a result of our tight labor market. Obviously, more job creation creates new households. So if you were sharing an apartment with a friend, you get a job at one of the high-paying Fortune 500 companies in the area, you're going to strike out and get your own apartment or move out of mom and dad's house and start your own household as well.
Where are we at? So you already said vacancies and rent growth. Where are we at with cap rates of the various A, B, and C product type?
Yeah, again, that really, really varies depending on asset class and depending on the individual deal. If it's a value add deal, if it's a core plus deal. Yeah. So it could really be all over the board, and sometimes it could be a little bit misleading depending on the underlying factors of what the deal is. But I would say 6% is probably a rough market-wide average.
Do you know what that compares to? What more of a historical? Because obviously caps are compressed everywhere. What's that compared to more historical in the Twin Cities?
Yeah, cap rates have compressed pretty significantly. We were probably in the 8% range not terribly long ago. So if you looked at the early part of this expansion, they were probably in the 8+ % range. So they've come down, I would estimate, close to 200 basis points, which is pretty significant. Again, very, very significant for this market, in terms of what we're seeing around the country, New York, LA, some of those gateway markets, trophy assets could be trading at a sub 4 cap. So
Yep.
it's all relative. And I think that's why you're seeing a lot of out-of-state and investment capital coming into this market, because even though cap rates have compressed, they're still much more attractive than they are in some of the primary gateway cities around the country. So the Minneapolis market is no longer the best kept secret in the country. I think investment capital has definitely discovered it and found their way here.
Yeah, I heard a statistic, and I don't know how accurate this is, but I heard a statistic that 87% of all the apartments in the Twin Cities are owned by local owners. And that was by a broker who said that that this year they sold 8 deals over 100 units, and 7 out of those 8 were bought by out-of-state investors.
Yeah, I would believe that. Absolutely. I think, typically as the economic expansion gets a little older, a lot more out-of-state capital comes in here looking for value. I think a lot of the local owners become sellers, realizing that the market may be a little frothy. And then typically in times of economic slowdowns, the local owners jump back in because they realize the actual value of the assets, and they'll typically become buyers in downturns. So
Yep.
it's interesting. And, I also think there's a different dynamic in how they manage the properties. I think local owners, by and large, tend to be more concerned about maintaining high occupancy and aren't necessarily going to push for every last penny of rent growth, where institutional owners will come in and are willing to sacrifice occupancy in favor of very strong rent growth. So just different models and how they're managed.
Yeah, definitely. Well, let's talk a little bit about the overall kind of economy, what's going on, what you're seeing, so maybe some trends that are happening, either that are positive or maybe concerning as well.
Yeah, I think we're getting a lot of mixed messages on how
definitely.
we're doing nationally. Looking at this as objectively as I can, I don't see any major red flashing lights that a recession is imminent. The stock market continues to perform well. The S&P broke 3,000, I believe, for the first time in history this year. Wages are increasing. Unemployment rate is at historic lows. So if you look at those factors, we're doing pretty well. And there's no reason to believe that that's necessarily going to change anytime shortly. That being said, there is a lot of geopolitical risk out there and the great unknowns. I think in terms of the trade deals, that's really something to keep an eye on. Whether that gets resolved and how it gets resolved is a big issue. Certainly, it's hurt a lot of people, particularly here in the Midwest, in terms of people in the agricultural field, manufacturing, trade industries. Obviously, it's had a very negative impact there. And if this continues to grow and accelerate, and the tariffs increase, and the global economy slows, that certainly is a legitimate risk. Tensions over the past few weeks seem to have been rising in the Middle East and the Persian Gulf. So who knows what's going to happen there. But in terms of what we do know, I think the fundamentals of the economy look pretty good. So, it's interesting. All the numbers look positive, yet everybody from Wall Street to the White House is begging the Fed to continue to cut rates. I'm not sure if that's the wisest move. The inflation rate is still below the target of 2%. Again, the job market is strong. So you wonder if these rate cuts are really more politically motivated than economically motivated to make up for some of the damage in the trade wars. So that's certainly interesting. But even in the next 12 to 24 months, I think that there is a general consensus that we're due for an economic slowdown, but that doesn't necessarily mean recession.
Yeah.
It would just mean that job growth slows for a couple of quarters and a couple of years and starts rebounding. So even if we do head into a downturn, I wouldn't expect it to be nearly as severe as the Great Recession that we came out of. I think I think there's still a lot of PTSD surrounding the term recession from what we came out of in 2008, 2009. But that's a 1 in 50 year event. Most of the recessions that we've had outside of that have been much more mild, and I would anticipate when the next one does arrive, it would be of the more mild variety.
Yeah, I think the typical recession is right around 6 to 8 months, is it somewhere around there? Versus what we went through was a pretty substantial recession.
Right.
But like you said, everybody remembers what just happened, not what's happened in the past. A lot of people forget. Yeah, 2000 or 2001, whatever that was, we had a small recession too. But that was for a short period of time, not massive bounce down.
Yeah.
And so we'll see where it goes. I've been hearing 12 to 24 months for probably the past 4 or 5 years now. I think in 2015 it was we're in the 9th inning. We've got 12 to 24 months, and now in 2019 we're in the 9th inning as well.
Sure.
We've got 12 to 24 months, so we'll see where that goes. It's always interesting to hear the trade wars. Some of the other stuff that you talked about with the political risk and the trade war, and that, in my opinion, is very interesting to see what will happen. How much of our economy is driving from manufacturing and from agriculture? Do you know in the Twin Cities? I'm putting you on the spot, so if you don't know, that's okay.
Yeah, I don't have the hard numbers. Obviously, northern Minnesota has a much greater exposure to agriculture. Clearly that industry has been hurt, particularly in terms of soybeans and pork products, not being able to export them. So we have enormous crops that are really just sitting there. Manufacturing, there's a little bit of a boost initially when the steel tariffs first went into effect. So if you were manufacturing raw steel, you probably did okay. If you were any other firm manufacturing anything that had to do with steel, you got hit hard by price increases. And for all the talk of manufacturing jobs coming back, we're not seeing that, and I don't think it's going to happen regardless. Quite frankly, even if we did see a large number of manufacturing jobs that were ready to come back to the U.S., we don't have the facilities, the modern production facilities. Not a lot of manufacturing facilities have been built over the last 10, 20 years. So even if those jobs are ready, we don't have the facilities for modern production. So I wouldn't count on that.
Who's going to take the chance too?
Right.
That's going to be the biggest struggle. Even if they do come back, if the opportunity comes, it's going to be a struggle to convince companies to take that risk that these jobs aren't just going to be here for the next couple of years. They're not going to be here just when whatever, if Trump gets another election, even, that's only 4 years, or 5 years. So we're not necessarily guaranteed that these jobs are going to stay. So I don't want to take that risk. I think there's going to be a lot of that attitude around, or if I'm going to take that risk, that's fine, but you, government, get to pay for it.
Yeah. And I think there's just fundamental shifts in the manufacturing landscape where it's not so much trade agreements, it's really automation that's caused the decline in the manufacturing sector. So I know not too long ago, The Economist news magazine did a study, and they found for every one job in manufacturing that was lost due to a trade deal, 9 were lost due to automation. So
wow.
I think that's a bigger impact than trade deals on the sector.
Wow. Very interesting. Wouldn't have thought it was that high, but yeah, I mean, definitely technology changes are drastically affecting it.
Yep.
Is the Twin Cities bringing in technology jobs?
I wouldn't say it's a technology hub. I think we're trying to grow and attract tech companies. I think what we do have are a lot of locally based, homegrown, organic firms that have sprung up. I would say our bigger industry is probably biotech, with Medtronic and some of those other larger firms that we have here. But in terms of replacing or being an offshoot to Silicon Valley, frankly, no, and I don't see that happening. We have the whole Amazon HQ2, show that went on a couple of years ago. it didn't work out, this has never really been a market that's attracted large out-of-state firms to relocate here.
Right.
So I wouldn't anticipate to see that going forward. You look at even our larger firms, Target, Best Buy, they're all, essentially homegrown firms. So, we're never going to be able to compete with some of the other higher growth markets. I shouldn't say never, but it seems in the current climate, we're not going to be able to compete with those in terms of incentives to lure major companies to relocate here.
Definitely. Well, Mike, lots of data so far. Anything else that you want to hit on before we wrap?
Yeah, I think overall, again, the picture looks good. Our local economic picture in particular is very strong. I think our tight job market has helped in terms of in-migration to the state. It's been a long time since we've seen people relocating in large quantities from other states to here. I think our job market is very attractive. Sub 3% unemployment rate, again. So if you're an employee looking for a job, you have a lot of leverage here.
Yeah.
And I think that's fueling a strong commercial real estate sector. Again, the much maligned retail sector, it's still performing relatively well here. We're not seeing major fall-offs. We're seeing a lot of brands refresh. We're seeing a lot of innovation in the industry, new concepts coming along. Industrial continues to boom, and I think we'll see that continuing for a long time as e-commerce continues to grow and the grocery world continues to converge. The office sector, it's steady. Again, I wouldn't say it's red hot like a Seattle, but if you have a well-located asset with modern amenities, you're probably going to perform pretty well and attract tenants. And multifamily just continues its 7, 8, 9-year run of exceptional performance. And I think the lack of affordable housing and the lack of building in the single-family residential sector here should keep demand high going forward. And if we do run into an economic downturn, I think you'll see even greater demand in those Class B and lower buildings as affordability will become an even more important demand driver. So ironically, if we do head into a downturn, renters of those Class A luxury buildings may wind up getting the best deals because that's virtually all that's been built this sector, this expansion.
Yeah, there's not a lot of affordable housing being built. So a few companies out there that they're doing a good job at it, but most companies are building the A class.
Yep.
Or A++ class.
Exactly.
Yeah.
But yeah, I think the picture looks really good on the Twin Cities, both economically and in terms of commercial real estate.
So when's your prediction for an economic downturn? Is it 12 to 24 months, or is it I just have no clue because I have no clue.
We kind of have a little joke that economists have predicted 7 of the last 5 recessions. So if we were any good at this, we'd be making a lot of money doing something else.
You gotta love it. Awesome. Well, Mike, I appreciate the time. Ton of great value and knowledge. And how can our listeners reach out to you if they want to get more information on CoStar and what you guys do with CoStar?
Sure. If they want to drop me an email, it's mroessle@costar.com. And if they have any questions about the data or about the product, I'd be happy to get the appropriate person in contact with them.
Awesome. And you guys obviously provide that information, and it's on the CoStar subscription. If somebody were to sign up, it's on the market that they're interested. They would, sign up and pay for that. Is that right?
Yeah, that's correct. I'm not on the sales side at all, but if somebody's interested in that, I'm happy to put them in touch and get some more information about that.
Awesome. We'll put that in the show notes so people want to reach out to you, get that information, do a call to see if it makes sense and move forward. Definitely a powerful tool. I do know that. So
great.
Awesome. Well, I appreciate it. And you have a fantastic rest of the day.
Yeah. Thanks, Todd. I appreciate the invite, and it was great talking to you.
Definitely.
Hey, special thanks to Mike for joining us on the show. Appreciate the value and the insight he was able to give us on the market. This is a little bit different episode that I usually do, so I didn't ask him some of the same questions that I ask most of my guests, but just a real quick recap. He talked about a lot of different sectors and what's going on in the market in multifamily, which I focus on, where you talked about the vacancy is very low, 4% in many markets, potentially even less or slightly more, but very low. Rent growth is, in Minneapolis is 3.6, which is actually extremely high, even though it might not sound high, but in Minneapolis, it's very high. In many markets, you're seeing it between 3 to 5, maybe even higher as far as rent growth. And there's really no flashing red lights honestly, in any sector, in retail and industrial and office. There's no flashing red lights. Everything's right now looking good, which is a time to be cautious for sure. When things are looking very, very bright everywhere, we do want to be on our guard, but we also want to continue to push forward, at least in my opinion. Push forward if you can continue to buy deals that make sense. So we're still undersupplied. We need a lot more units on the market. We're way, way low on vacancy. So those lend to, honestly, good opportunities to buy. Interest rates are low. So again, appreciate Mike. The other thing he talked about was with the economy, there's mixed messages, but there's no real big flashing lights. Wages are up, beginning to grow, which also lends well to these rent increases. Unemployment's extremely low. There's, of course, political risks. There's trade war risks. There's different risks out there in the market. But again, if you're buying, if you're being prudent, if you're paying attention to the market, if you're understanding where it could go, and you're stress testing your deals, I think you'll be good to continue to buy as long as you're not being too aggressive. So I just want to talk to you real quick. If you have an interest, I am taking a small group of people that want to take their business to the next level. So I've been able to, as most of you know, take a $20,000 and turn that into a net worth of over 8 figures. And I want to help you do the same thing. And so what I'm doing is creating a group of people who want to have success in real estate, in multifamily, and take their investing to the next level. And we're going to do a group session, so you'll be able to learn from me. I'll be bringing in other industry experts, other mentors of mine, people that have had an extreme amount of success, and we'll learn from each other. We'll have opportunities to partner with each other, to do deals with each other, to bring experience, and just to really help build a business that can be powerful, that can create that financial freedom that you're looking for. So if that's something that's on your mind and on your heart, and you want to just have a phone conversation with me to see if it's the right fit, I'm not going to take everyone. And I want people that are fully committed. I want people that are 100% in. So if that's something that you think, hey, this might be a fit, or I want to learn more, let's just have a one-on-one phone conversation, short conversation, to see if it works, if it's right for you, if it's right for me, and potentially work together. So you can go onto my website. It's coachwithdex.com. It's coachwithdex, DEX.com. And you can just fill out the form on the website and see if it's a fit for you. That's it for me. Have a fantastic rest of the day, and remember, make every day a Saturday. Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.